out in our opinion that the Trump administration wants a weaker dollar and they don't want yields to get out of control. I would just generally say we believe the Trump administration will be very market aware. And so as they announce policies or as they get into the detail of those policies, they very likely will dial in and dial out those policies based on market reaction. And we believe that someone like their current nominee for Treasury is someone who is going to be generally market friendly. I think the market's like that. But I would say I don't think it was just the announcement over the weekend of the Treasury nominee that's driving yields lower. I do think positioning played a role. Yields have moved up a lot over the last couple of weeks, and I think some people were taking the opportunity to buy into these higher yields with the hopes that you have a longer-term game plan with yields going lower and bond prices going higher.
So I got to ask you, right, how are they going to achieve that when one of Scott Bessent's many jobs, assuming he is confirmed by the Senate and manages to pass through there, one of his many jobs is going to be redistribution of the term premium, right? The government is paying probably too much, right, to issue mostly at the short end. They need to move it to the right, to the long end. That is necessarily going to push yields higher there, no?
I do have a little bit of worry along the yield curve. Our view is that the belly of the curve is probably a pretty good opportunity for investors to be deploying dollars. If you can get 4.5%, 5.5% like in yield, depending on the credit quality in the belly of the curve, the need to go further out in duration for investors is pretty low. And we do believe that the market is underpricing term premium, particularly when you go out 10 years and longer, like to the 20-year or the 30-year time frame. So we think the sweet spot is in the belly of the curve. And obviously, we think the shorter end of the curve, the yields are likely to continue to go down because we are in the camp that the Fed will continue to cut rates. So the sweet spot, in our view, for investors and what we're positioning in our portfolio is really the belly of the curve. The idea that you can get respectable yields there. It's not too far out from a kind of broader concern when it comes to broad debt issues, but it's the sweet spot for both investors, but also still allows the government to push out the yields and the bonds that they're issuing at least out to that 7 to 10 year type of time frame.